Hey everyone, how's it going? We're back with another training. Today we're going to be looking at Widget Corp's financial statements again. If you didn't watch the income statement training, I'd encourage you to go back and watch that one. But we have the income statement right here, exact same income statement. Today we're going to be looking at Widget Corp's balance sheet and talking about the key line items here. So the balance sheet is divided into three sections. We have assets, liabilities, and shareholders' equity. Generally speaking, assets are things that give you a future good, something good happens to you in the future, and liabilities are things that cause something bad to happen to you in the future. Equity is defined as the difference between assets and liabilities. In fact, if we take our assets and we subtract our liabilities, then what we get is our shareholders' equity. And I could roll that forward. You see it happens for every year. So let's hop into the assets. Assets and also liabilities are divided into current and non-current. Current are things that expire or we expect to, care about for the next year or so. Non-current assets generally are more permanent. So let's start with cash and cash equivalents. You might think that this would be a really important line item that investors would care a lot about. But the reality is, except for companies that are like facing imminent bankruptcy, like they're at risk of running out of cash, investors don't actually care that much about cash balance, at least not like this future cash balance that you can imagine right here, because this is determined by other things. It's determined by your revenue and your expenses. So your profits get added to your cash, and then other things you might have to spend money on, like if you're going to buy a new factory, that'll decrease your cash balance. But we care more about looking at those things directly as opposed to looking at their effect on the cash balance. In fact, if you see really high like cash balances, sometimes that's actually a bad thing because it means that a company doesn't know what to do with their cash. So, if you have cash, you could reinvest it in your business. You could do some research and development. You could buy a new factory. Or if you really don't have anything to do in the business, you can return it to shareholders through a dividend or through share buybacks. And so companies that aren't doing any of those things generally are questioned by investors on whether they actually know how to do effective capital allocation. In fact, this is kind of funny. In Japan, there are lots of companies with huge cash balances, and I think it's just kind of a function of like the conservative business culture in Japan. They're just not as focused on profitability and shareholder value as American companies are, but there are hedge funds in Japan that specialize in convincing Japanese companies to spend their cash and generate shareholder value that way. So I just think that's interesting. Inventory. Inventory, there are three types of inventory. There's work in progress inventory, raw materials, and finished goods. And so this is this inventory. Generally, you want to have some inventory to support future sales, but you don't want it to be super high, because what happens if you have too much inventory that you can't sell? Well, it might go bad, and depending on what the product is, it could go bad, or it could be obsolete if it's a high-tech product and you're not able to sell it for a couple of years. Maybe it goes obsolete or decreases in value. But that's something to be concerned about. Also, if you have a lot of inventory and you want to sell it really fast, you're going to have to lower the price, which is going to give you lower revenue and lower profits as a result. So generally, we like inventory to be low, but not super low, because then we won't be able to support future sales. Accounts receivable. Accounts receivable is when you've made a deal with your customers that they are not going to pay you immediately. So you deliver a product and they say, can you give us a couple months to pay for this product? And you say, sure. So generally speaking, this is fine. If it's kind of a low amount, give your customers some more flexibility with how they purchase your good. But if it's really high, that's not fantastic, because that means your customers, when it gets really big, there's some doubt as to whether your customers will ever pay you. But also, it's kind of like you're giving a loan to your customers effectively. You're allowing your customers to use the cash that they otherwise would have given to you to do whatever else in their business. So you're effectively loaning to customers. So generally, you don't want to be loaning to customers as much. In fact, large accounts receivable balances might indicate that your company doesn't have a lot of power in a negotiating scenario, maybe because your product is bad or whatever. I wouldn't draw too many conclusions from accounts receivable, but it's a good thing to know. Non-current assets, remember, these are more permanent assets. Property, plant, and equipment, I think, is pretty self-explanatory. This is real estate, factories, machines in your factory, things like that. Generally speaking, you want to see this. The company will increase this in expectation of future revenue. So you can see that the company is increasing their property, plant, equipment in order to support future production in these years. So things to be aware of here. Property, plant, equipment depreciates, and that is a non-cash expense. So if you have a lot of property, property doesn't depreciate. If you have a lot of factories, and that's depreciating, then you could see that draw down your profits, but depreciation doesn't draw down your cash. That's a more complex topic that we can maybe get into in another training. Goodwill and other intangibles. This is a weird accounting line item. Goodwill happens when you buy another company. When you buy another company, usually you pay more for the company than the value of the company's assets. If the company has like $1 million worth of factories, you would probably pay more than $1 billion because the business has some value. And in order to make that balance on the balance sheet, this isn't just assets, this is book value. So in order to make everything balance on your balance sheet, you have to have some plug line item, and that happens to be goodwill. So this just represents, how much more you're paying for when you acquire a company than the company's assets minus liabilities is worth. So an example of this is like when Microsoft bought LinkedIn, they paid a lot more than LinkedIn's book value. The issue there was they found out that they actually overpaid a lot for LinkedIn. So Microsoft incurred a really big goodwill write-down. So they actually decreased the value of goodwill on their assets because they overpaid for LinkedIn. And as a result, they had a really bad quarter that quarter because their profits were down so much as a result of that write-down. Liabilities. Okay, remember, these are things that give you a future bad. Something bad happens to you in the future because you have a liability. Current liabilities, they're short-term things. Accounts payable. This is similar to accounts receivable, but it's on the supplier side. So this is when you are buying things from your supplier, you're buying inventory, and you're not paying for it immediately. This is actually good for your company because you're negotiating these terms with your suppliers. And so they're essentially giving you a loan. They're saying, you know what? You don't have to give us cash right now. You can use the cash to finance your business, and you can pay us later. We don't want this to be super high because then we run the risk of not being able to pay our accounts payable, and that would cause bankruptcy probably. But we don't want to, we're comfortable. Generally speaking, companies enjoy not having to pay for their stuff immediately. Deferred revenue. This is a little bit of a complicated one. Whoops, I just deleted it. It's a little bit of a complicated one because this is a line item that usually applies to companies that provide services. So this is when a customer orders a service and they give you cash for it. So they're paying up front. Maybe it's a software contract and they pay you for the whole year for your software contract, but you haven't delivered the service yet. So the reason that's a liability is because in the future you have the obligation to deliver that service, which is going to cost you, maybe in the software scenario, maybe you have to pay hosting costs or maintenance. You need to pay your maintenance engineers, whatever. So that's deferred revenue. This company sells widgets, which are not a service, so they have zero deferred revenue. Let's move on to short-term loans. These are loans with a maturity of less than a year. So for whatever reason, a company might take out debt to finance things in the short term. Maybe they don't want to use their cash balance for whatever reason. Maybe they need to buy some factory equipment or something. You can see that they always pay this off within the year. So these short-term loans don't roll over. Because they're short-term. You need to settle them by the end of the year. Current portion of long-term debt is similar, except for this is your long-term loans that are due within a given year. So you can see in this year, which is 2019, there are no long-term debts due. In this year, there are 20 million of long-term debt that's due to be paid at that time. In 2021, there's nothing. So you can see if we go to the bonds payable, which is the long-term debt, there's $100 of long-term debt. And this year it goes down by 20 because it moves to the current portion. So $20 of this has moved to the current portion because it's due that year. and the company pays it off in this year. So you can see in the next year, there's still $80 of long-term, but there's none due in 2021. So hopefully you see kind of how that dynamic works. And obviously you don't want to have lots of debt that's due in the short term because you might not have enough cash to pay for it. Deferred taxes, these are permanent, and these usually occur either in an M&A deal or when your company loses money. When your company loses money, your government actually kind of pays you a negative tax rate. So rather than you paying taxes, they say, you know what, you lost money this year, you don't have to pay taxes in the future, and they'll give you a little bit of a tax asset, a deferred tax. I guess in this case, it's a liability. So this company has 0 deferred tax liabilities that they have to pay in the future. But deferred tax assets also exist. This company doesn't even have a line item for that. But that's a thing too. So that's all the liabilities. Assets, future good. Liabilities, future bad. Now let's look at equity. I think equity is the least useful to look at when you're analyzing a stock. So I'm not going to highlight anything here except maybe that retained earnings goes up when you generate profits and down when you pay dividends out of those profits. And as you could see earlier, the balance sheet balances, meaning that assets does equal liabilities plus owner's equity, and we can verify that if we say this equals this plus this, and it's going to tell us true if that equation is true. We can roll it forward, and we can just check that everything balances. This is a good way to when you're doing financial modeling to make sure your balance sheet balances is just put this formula that says true if it balances. So what are some analysis that we could do on a balance sheet that'll give us more information? One thing we could do is look at short-term liquidity. We can use something like the current ratio. So I'll F2 into this and show you what this is. We're comparing the ratio of our current assets to our current liabilities. So you can see that in this case, we have more current assets than current liabilities. And so this ratio is more than 1. You can imagine that if this ratio was less than 1, you might be a little bit concerned because, if something happened and you had to settle these short-term liabilities, you have to pay your suppliers, you have to pay these short-term loans, you would not have enough assets to cover that. You wouldn't have enough cash, inventory, and accounts receivable. In fact, maybe this doesn't, you might argue that this does not tell the full story because inventory, like say some of your inventory is raw materials, you're probably not going to be able to sell raw materials for the full amount that's listed on your balance sheet. And so you might even discount the amount of inventory when you're looking at current ratio or short-term ability to meet obligations. And you can modify the ratio however you want to reflect that. Net debt, this is just a metric of debt where we take our debt and we subtract cash. And technically there are other things that you want to include in net debt, but this is a very simplistic version. And it just looks at what's our debt. If we paid off as much debt as we could with our current cash, how much net debt would there be? Not very useful by itself, but we can use it in the next ratio, which is net debt divided by EBITDA, which represents if we used all of our cash to pay down our debt, we just paid down cash as fast as possible. How many years would it take? And this is not a completely accurate metric, but it's rough. It's a rough estimate of how many years it would take to pay off all our debt. So 1.8 times means that in order to pay off all our net debt, it would take 1.8 years worth of EBITDA to pay it off. And you can see this ratio decreases as we pay down debt and our EBITDA gets higher. So that means that our leverage is decreasing. So this is a leverage metric. Interest coverage ratio is similar, but this is looking at a company's ability to service their debt. So this company is incurring a certain amount of interest expense every year. So I'm looking at the income statement here. Every year they've got $10 in interest expense that they have to pay. So the question that this ratio answers is, what percentage of our EBITDA is interest expense? So 18.5% of EBITDA. So this is kind of a profits measure. Do we have to pay on our debt? And you can see that ratio is going down. So our interest burden, the amount of interest that we have to pay as a percentage of our EBITDA is going down over these 3 years. So those I think are liquidity metrics. Debt investors are interested in these ratios pretty often. Maybe someone who's looking at an equity, like a stock that's close to bankruptcy, might be especially interested in these ratios. But ratios that an investor in a growing company might look at are return on assets and return on equity. So return on assets is we just take our net income from our income statement and divide it by our assets. So this is answering the question, how efficient is this company at turning assets into money? How well do they use their assets, their factory, their cash, their accounts receivable to make money? And you can see this is increasing. Actually increasing kind of a lot. It goes from 7.3% to 13.6%. That's pretty good. Return on equity is a similar measure. We're just dividing our net income by our shareholders' equity, and that's telling us how efficient is this company at turning their equity, which is assets minus liabilities, into money. And these are actually closely related. How are they related? They're related by the ratio of liabilities divided by equity. So if you take return on assets divided by equity. If you take return on assets, multiply it by assets divided by equity, it gives you return on equity. Now that assets divided by equity, this is something you learn in 201, or at least I did. I don't know about you guys, but assets divided by equity, this is a measure of leverage. If your leverage goes up, this ratio will go up. If your leverage goes down, this ratio will go down. And I'd encourage you to think about what the individual line items are here that are like what moves this ratio. But generally speaking, the reason that return on equity is higher than return on assets is because this company uses debt. They have liabilities. They're being financed in part by debt financing and by their customers with these accounts payable. So hopefully that taught you a little bit something about the types of things we look at on the balance sheet. I'll just reiterate, generally speaking, the balance sheet is less useful for companies that are kind of growing, don't have any problems with bankruptcy, but there are a lot of companies for which the balance sheet is worth looking at. And it's important to think about the consequences of leverage on any given company. So I'll end there. Next time we'll talk about the cash flow statement.